Hello traders, this is Fawad Razak, the market analyst for City Index. Today is the 9th of January 2023. So the markets are a little bit quiet and everyone's waiting for the CPI to come out on Thursday from the US. We'll also have PPI data on Friday. In addition, we have inflation data from Australia and China, among other places to come as well. Now the US 10-year is continuing to hold below the 200-day moving average and resistance at 410. That level is key for as long as it remains as resistance and caps the gains. The path of least resistance for bond yields will be to the downside. So if yields go down, things like gold, silver and indices should continue to ascend. Now the dollar index is still holding below this key area of resistance. So the path of least resistance remains to the downside for as long as the shaded red area holds as resistance. It has had a few attempts to break above it. So far it has held. So let's see what happens in the next day or two when we have those inflation figures released from the US and elsewhere around the world. Keep an eye on this area. So starting with the euro dollar, things haven't changed much. As you can see, rates have been consolidating around the 21-day exponential moving average for the last several days, holding largely between support at 109 and resistance at 110. It will need to move out of this range for it to start trending in a particular direction. So for the time being, there's no directional bias on the euro dollar, but the longer term trend is still bullish given that the 200-day moving average, for example, is still pointing slightly higher and we are holding above it. Here's a chart of gold. As you can see, price of gold has been consolidating as well at around a short-term support level around 2030, this blue line here, where it had previously found resistance and support from in the past. And despite its bearish close yesterday, it has bounced back because of slightly weaker bond yields. And so the bullish trend remains intact for the time being. There is a short-term bearish trend line that needs to be taken out before we start trending higher again. If that happens, then the next key level of resistance is at 2075 to 2080. This area had previously offered resistance back in May of last year and previously at the height of the pandemic in 2020. Silver hasn't moved much in the last few days. It is continuing to hold support at around this blue shaded area at around 23-ish. The next level of resistance above this area is at 2365, this red level right here, which converges with the base of the breakdown from last week. And also we have the 200-day moving average converging with the bearish trend line at around that area. So a move above that zone could pave the way for a potential rally towards the December's highs of 25 plus. On the downside, 2335, the head of this hammer candle, could be the next downside target, should support breakdown here. Now, I mentioned earlier we have some inflation data to look forward to from Australia as well as the US and China, which means that the Aussie dollar is going to be a busy currency pair to trade. And right now it is continuing to hold support at around this level, which was previously resistance. We've had two attempts to break below this in the past couple of days. So far, the Aussie has finished above that level. So that level I'm talking about is at around 66.90-ish, 67. So that level remains an important pivotal zone for the Aussie insofar as the short term is concerned. Slightly below that, we have 66.10, where the base of the previous breakout occurred. There's also this bullish trend line to keep an eye on the Aussie. It's not a clean one, admittedly, but nevertheless, it is there. So this is an additional technical factor to watch moving forward. So far, it's holding above all of these key levels I mentioned. So the path of least resistance is still to the upside, but we do need to see upside follow through now above these hammer-like candles that were created in the last couple of days. Mirroring price action in most other markets, the FTSE hasn't moved much in the last few days. It is still holding its own relatively well above the 21-day exponential here and support at 76.50-ish, this blue line here. It's not a clean level, admittedly, but the key takeaway point is that the trend is still bullish. Price is holding above these moving averages. It's making higher highs and higher lows. And so we need a clean break above this area of resistance where the FTSE had previously struggled, as you can see, at around 7,700 to 750-ish or thereabouts. A clean move above that area could pave the way for a potential move up to the next level of resistance, which could well be at around the 8,000 mark or slightly above that, where the FTSE had previously hit a record high back in February of last year. The DAX has been trending higher on the longer term charts. This is the monthly chart. As you can see, the last 2 months saw bullish price action, causing the index to break above the previous record highs that were set in 2021, 2022, and then a number of times last year. So we've moved to fresh record highs, but the rally has stalled. But the key level of support at 16,300 remains intact, this level being previously resistance. So let's see on the shorter term charts to define our levels more precisely. Yesterday saw the DAX rally above the hammer candle that was formed on Friday of last week. So let's put a line on the high of that candle. So that level comes in at 16,650. That level now needs to hold as support. So far, the index is slightly below it. So a bit of a bearish move there, but the day is not over. Let's see if it can reclaim that level later on in the session. If it can, then this will keep the bullish momentum alive. And you can actually move this line down a little bit to connect the few other highs that were tested prior to the breakout, which in fact is now being tested as support right at 16,630. For more analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.